I'm Yahoo Finance Executive Editor Brian Sozzi, taking a look at a live shot of the opening bells on Wall Street on this Wednesday morning. This week, just flying by. Grab a gun, ringing the bell at the NYSE. Aura Minerals getting things popping over at the NASDAQ. No shortage of things for traders to digest out of the block today. On the one hand, conflicting inflation readings this week have caused a rethink on rate cuts on Wall Street trading desks. Expectations show now there's only a 50-50 chance of a rate cut at the Fed September meeting. A July cut looks to be off the table. This concern appears to be overshadowing another strong profit showing from the big banks, in part fueled by record-setting markets. Now, on opening bid, we're all about serving up investing analysis you need to know to unleash the power of your portfolio. We're digging into what's really moving stocks, giving you the unbeatable context to make decisions with all that money in your portfolio. All right, let's get on down to the NASDAQ in Times Square and check out Yahoo Finance senior reporter Brooke DePalma. Brooke, no mascots ringing the bell today, snapping my two-day win streak.
No mascot today, just like Ollie's Bargain Outlet did yesterday. But investors certainly in the pleased with this morning's outlook after the producer price index came in flat. We're seeing stocks open all in the green, but not really moving much. And I really like a note from Citi's economist Stuart Kaiser, or strategist rather. He said that investors really have turned a blind eye. This has been a week where we've gotten solid earnings. We got a light consumer price index. We saw a producer price index flat today. In addition to that, we also got positive headlines on tariffs. But as we've seen over the past few months, investors aren't really, moving big money either way, up or down, as we've seen in the past when tariff headlines really made major moves in the markets. Taking a closer look at the open today, we had the Dow in the green, up roughly 0.3%. NASDAQ just slightly higher, moving higher this morning. S&P 500 also moving higher. But I do want to take a closer look at crypto stocks. We know that Genius Act is currently on the Hill this morning as set to pass. And so what they're dubbing, the House of Representatives dubbing Crypto Week, that's ultimately moving cryptocurrencies higher. But Bitcoin, after we saw that record high come out earlier this week, if you take a look at the 5-day, that reached above 120,000 thresholds earlier this week. On Monday, we saw over the past 5 days, it's up 1%. Now investors sort of backing down perhaps this Genius Act already priced in this morning. But we also have moves on Ethereum up nearly 5%. And I also want to take a look at the crypto stocks like Robinhood, for example. What we've seen this year to date, is really these stocks rally over this regulatory environment, or rather regulatory risk lessening over time, as the Trump administration really has taken to the liking of these cryptocurrencies, of stable coins, and really these key 3 crypto bills on the Hill currently underway. We see Robinhood up more than 170% year to date, Coinbase up more than 60%, and certainly those are stocks we'll be watching as we get underway of this Wednesday morning. Back to you, Sozzi.
Sizzling moves indeed. All right, thanks so much, Brooke. Appreciate it. All right, we're kicking things off with your daily guide to the biggest market drivers of the trading day. Here's what I'm watching. Number one, big bank earnings fest is alive and well today, folks. Bank of America, Goldman Sachs, and Morgan Stanley all handily beat earnings estimates for the second quarter. But for the quarters, there couldn't be more different amongst a lot of these companies. Goldman Sachs had the best quarter from the big banks in terms of investment banking and trading. Morgan Stanley struggled in investment banking, but showed strength in its lucrative wealth management business. Bank of America's results displayed a resilient U.S. consumer, as seen through the prism of solid spending on credit and debit cards. Number two, the producer price index came in somewhat tame versus estimates and cool compared to May. Very important there. This is a day after the consumer price index showed an uptick in inflation month on month, likely due to President Trump's tariffs. These reports have still triggered a swift reversal on Fed rate cut expectations by traders. Number three, an all over the map tech trade. NVIDIA is knocking on the door of $4.2 trillion market cap as CEO Jensen Huang hyped strong orders for H20 chips in a trip to China. Meanwhile, chip equipment maker ASML gets hit on a warning about demand on the back of global trade uncertainty. Now let's get after it with our roundtable. Mark Lehman, Citizens JMP Securities CEO and Citizens California President. Stephen Biggar, Argus Research, Director of Financial Services Research, and Yahoo Finance Senior Reporter Brooke DePalma is here. Stephen, let me start with you. Big bank earnings, by and large, done. We'll get the regionals. We watch those, of course, but big bank earnings are out. What's your top takeaway getting all the numbers?
Yeah, good morning, Brian. Right, it's been a pretty solid quarter for banks. I think the outperformance on both loan growth and investment banking for the most part has led to that. I think coming in out of the March quarter results in April, bank management was a much different environment. The tariff-related turmoil had put a big pause on investment banking, and even though some recent conferences, the banks are kind of a little bit more cautious on the improvement in investment banking. But clearly, either something happened late in the quarter or they were snookering a bit because results came out pretty strong with investment banking for most of the banks reported so far. And on that loan growth, also pretty favorable. We get good results from the Federal Reserve weekly data on lending. It was about 3% year over year, but you had JP Morgan at 5%, you had Bank of America at 7%. So these big banks are actually gaining share, I think, in these markets, and a lot of that is credit card growth, of course, but these are pretty good numbers.
Mark, good to see you here. JB Diamond yesterday called out a recovery in investment banking. Certainly saw a bit of that, or a lot of that, in Goldman Sachs out today. What's your outlook for the investment banking business for the back half of this year?
Thanks for having me on. It's definitely improving. The IPO window is open. The question is not whether it's open, it's how many people want to go through the window. And I think you're starting to see that acceleration like we saw in May and June, and you'll see in the back half of the year. So I would consider this a good back half backdrop. And the biggest way to predict that, of course, is what happened in the first half of the year. And most of those deals that came out are working spectacularly well. So my hunch is where you have more of a demand than supply, that gets to equilibrium. That means there'll be more IPOs in the back half and going into 26.
Mark, what are these private companies waiting for? We look at, markets are at records. The regulatory backdrop appears to be easing. What do they need to see to come public?
It's a great question.
Yeah, certainly.
I'm sorry.
Go ahead, Mark.
Yes, I think there's a couple of things. One is they want the path of profitability. They want visibility on their earnings over the next 4 to 6 quarters. Secondly, I think they really want to make sure that the investors that they have are supportive of the deal. And again, there's a bunch of unicorns that priced offerings in 2021 on the private side that are still not at those valuations. So that kind of denial phase, I think, is getting closer to behind us, and the acceptance phase about what the market has is in front of us.
Stephen, I'm looking for red flags. I don't want to sit up here and hype bank stocks. No quarter is perfect out of any company. As you sifted through these, really Goldman Sachs, Morgan Stanley, Bank of America, Citigroup, Wells Fargo wasn't that great, but what stood out to you in terms of things that investors should be worried about?
Well, clearly the back half is, there's still some concerns about tariff-related, turmoil. We get these kind of on again, off again tariffs, and of course the company managements have talked about that. I think there's certainly bank stocks have had a big head of steam here coming into the quarter. And so valuations are, a bit on the upper side, although, universally we raised target prices yesterday on companies that came out because earnings are strong and they mostly guided a bit higher. So it's hard to find a lot of fault in these other than, the valuations are a bit stretched unless we do get that investment banking rebound in the second half. And I think we're a bit counting on that, as well as some regulatory softness as well, softening some of the capital requirements in the back half. I think by the end of this year we might have some of that. So that could be another catalyst for bank shares on the upside. But at this point, we are factoring in quite a bit of improvement across the board.
Brooke, across all these banks, we saw really strong inflows into wealth management businesses. The markets have helped a lot of clients. I look at Bank of America, their credit and debit card spending up a combined 4%. Pretty good. I believe it's a deceleration quarter over quarter, but still good nonetheless. These are positive reads on the strength of the U.S. shopper.
Absolutely, Brian. What we've heard across many of the major banks that have a good pulse on the consumer is that we actually saw an uptick in spending year over year when it comes to aspects or sectors that we were really concerned heading into this earnings season, this earnings quarter about. We saw an increase in credit and debt year-over-year growth when it came to sectors like travel and entertainment, as well as food, retail, and services. That's according to Bank of America. And what we're hearing from a few executives on these earnings calls is that the consumer is in a solid place. And that was once again a big concern heading into this earnings season was, did the consumer hold up amidst all this uncertainty, especially over the course of April and May? Did the consumer still go out and spend? And now what we're seeing from these big banks is essentially CEOs saying that they did. We heard from Bank of America CEO saying that they saw solid consumer spending data. JP Morgan Chase saying the consumer basically seems to be fine. We also heard last week from companies like Levi's, like Delta, that consumers still are spending. And so this is really a bit of a surprise here after we've heard so much uncertainty about how exactly consumers will spend in this environment. We're seeing that consumers were able to hold up.
Mark, let me get back to you here. CPI, that headline increased month over month. PPI somewhat tame. We saw the rate in June come in slower than May. Is the reality that is it just that we're not getting any rate cuts this year and investors should stop positioning for them?
It's definitely pushed things out. I think understanding what the data shows you is really tough when we have these almost, weekly tariff announcements and delays. And I think it's really hard to get a gauge on what that means for the consumer and what it means for interest rates over time. And I think the Fed's job to fight inflation obviously is superior than worrying about a slowdown. And I think when there's that much uncertainty and that much gyration in policy coming from the White House, you'll probably see more pause than action. And I think that's probably what has leaked into the September numbers or September expectations, because these are really hard to gauge because they change so rapidly.
Stephen, if we're not going to get a rate cut, I would argue expectations for a rate cut is a large part why we've seen markets hit a record, really with that push coming over the past 3 months. Should the market correct? And is something like that coming if we're not going to get rate cuts this year?
Well, I think a lot of that depends on the industry you're looking to invest in. Ironically, perhaps I would say that the higher for longer is better for banks, right? They've been able to reprice the securities on the balance sheet. As long as they're getting this decent loan growth I talked about before at these levels, the higher interest rate levels, they're perfectly fine doing that. So I think the banking industry survives just fine in this bit of a higher rate environment. That's not true across the board, of course. If you're in some other areas and elevated rates could lead to this higher discount and lower equity valuations. But I think the market's being fairly taking it in stride in terms of these rate cuts. Our own house view is that we'll still have 2 in the back half of the year. We've been steady with that. We've not expected more all year, and we think equities can do good in the environment with rates where they're at, and a little bit better if we do get 2 rate cuts in the second half.
All right, we'll leave this chat there for a moment. Straight ahead, a super bullish call on Netflix before earnings on Thursday, and we'll have your stock of the day. Don't go anywhere. Welcome back to Opening Bid. Continue to keep an eye on Netflix ahead of its earnings release after the close on Thursday. Shares are down nearly 2% in the past 5 trading days as investors get antsy on one of the best performers in tech this year. Shares have surged 30% since the company's last earnings release, compared to an 18% gain for the S&P 500. Despite concerns on Netflix sustaining its rapid profit growth into year-end, Guggenheim analyst Michael Morris is out today taking his price target on Netflix to $1,400 from $1,150. He sees Netflix as an industry leader in content sourcing and distribution, lending way to a strong revenue growth potential outlook. All right, it's time now to call up our question of the day, and here it is. With big bank earnings season basically over today, what is the best way to play financials into year-end? Is it through the investment banks, as JP Morgan CEO Jamie Dimon sees a rebound forming in the business, or a bank with less investment banking exposure on fears the recovery proves fleeting in investment banking? All right, back with me is my roundtable. Steve, I want to start with you here. I was on a media call yesterday with BNY CEO Robin Vince, and he got asked about potential acquisition of Northern Trust, I believe. And that was like rumored about a month and a half ago. And it got me thinking, is one of the under the radar plays in financials, in fact, those regionals that finally, maybe this is the year we get some consolidation in the space?
That's an interesting question. Of course, that's been alive and well in terms of acquisitions for the banks at large. Going back to 2020, we had 5,000 banks. Today we have 4,500. So we've had 500 FDIC insured banks get taken out in the last 5 years, about 100 per year. So smaller banks are having a harder time competing in this environment. A lot of the loan growth, we look at J.P. Morgan adding 500 branches over the next few years. Just continue to gain market share and just have more products for the average consumer. I think regionals are struggling a bit here. All they have is kind of that loan growth environment, and they have to be in a decent service territory to extract a decent lending growth in their operations. So that's why we continue to be favorable on the large banks and those with capital markets operations that can see that better growth. And there's a long runway ahead, we think. A lot of pent-up demand in investment banking, for example, more M&A activity, an easier regulatory environment in the Trump administration, and they would be the prime beneficiaries of lower capital requirements and therefore be able to lend out more should that happen from the Fed. So it's kind of stacked in favor, I think, at this point of the large banks and the capital market centric ones.
Mark, where do you roll the dice here? Is it riding the investment banking momentum that we saw at Goldman Sachs, or is it something that, like a Bank of America, you bet on the resilience of the U.S. consumer into the back half of the year?
Yeah, our analyst, Devin Ryan, downgraded Goldman Sachs yesterday, and right in front of earnings. It wasn't a call that said there's something wrong with Goldman Sachs, of course. It was at this valuation level, does he think there's the next leg up? And that stock's done extremely well. He upgraded the stock in 2020 at $200 a share, so I think it's done quite well. The real question is there that another leg up? And I think we could put that across the whole market, which is we've had some real run-ups in a bunch of stocks. And is there that next leg up for those stocks? And what's going to be that catalyst for those names? And I think you will see big winners here. I think that the backdrop with the big, beautiful bill and what the administration has put in front, financials and technology should do really well in this cycle. They're the prime beneficiaries, I think, of the regulatory backdrop as well as AI spend and what that does for multiples over time. So I'm still quite bullish on financials. I do think we've had this pent-up demand in capital markets. I think some of the non-money center banks are not seeing the kind of multiple expansion yet. They've seen stock appreciation, but not multiple expansion. And I think you're about to see that. So it still should be, we've had this theme for stick with the winners, and we'd like that theme here at Citizens.
It's a good thesis on life. Stick with the winners. Brooke, you're a winner. Where are you looking at in banking right now?
If I take a look at the Yahoo Finance Interactive, what we're seeing here is JP Morgan have quite the run year to date, up 20%. But one bank that's really falling behind here is Bank of America. And I read a quote from an Evercore analyst this morning saying that Bank of America has lagged, but it is their preferred value play in the big banks. They trends are fine, profitability improvement will be deliberate as we wait for a better loan growth and investment banking backdrop. They said valuation is attractive, but just be patient. And you could see that Bank of America has clearly been a lagger year to date, up just 5% compared to JP Morgan's nearly 20% run and Goldman Sachs up more than 20%.
All right, thank you to Stephen Biggar for joining us for this deep dive into all things financials on Big Bank Earnings Week. Mark and Brooke, you stick with me here. Let's turn now to our stock of the day, and that is Meta. Meta stock has been one of the hottest tech plays of late, rising a cool 36% in the past 3 months. Attention is now turning to Meta's earnings in just a few weeks, and if the results will be strong enough to justify the headier valuation. But CEO Mark Zuckerberg's aggressiveness on the AI talent front is bringing to light again a key question on Meta. Is it spending too much money and risking its near-term profits? Doug Clinton, Intelligent Alpha founder and CEO, says Zuckerberg could pull off the CapEx spend.
Mark Zuckerberg he's the ultimate wartime CEO. When he sees an opportunity, I think he attacks it really like no one else. If they can get something going in the right direction there, that might be good for the stock.
All right, but points out BofA analyst Justin Post, we expect an AI investment to be a top focus area on the upcoming earnings call And Meta likely needs to make a case for strong AI returns to drive multiple expansion. Yes, it does. Jumping onto the Yahoo Finance platform, you can see Meta's forward price to earnings ratio is about 29 times. That's above the 5-year average forward P ratio of 25 times. Still with me here is Brooke DePalma and Mark Lehman. And joining us is Yahoo Finance tech editor Dan Halley. Dan, thanks for phoning in or videoing into the show here. Now, you heard our guest there talk about Zuckerberg as a wartime CEO. What will that mean in terms of costs for Meta? This is a company already expending tens of billions of dollars on AI, but do you think the street could be surprised by how much they are going to say they are going to spend for the rest of the year?
Yeah, I mean, look, he's said that they're going to spend hundreds of billions of dollars on their data center build out. Now, that's probably over the course of several years. He talked about some of the data centers that they're building now, which are Prometheus and Hyperion, one of which, the Hyperion, is going to be about the size of Midtown Manhattan. These are things that they're going to be doing for the long term. And so, like you would see with Microsoft or Google, who build out their data centers, and then that's an asset that they have for 10, 15 years into the future. You'll see that with Meta as well. I think the big splashy spending that they've been doing on hires. In an interview with the Information yesterday, Zuckerberg had basically said, "Look, yeah, we're spending a lot hiring people." He didn't necessarily call it poaching, but he said getting the best team members that they can find. That doesn't really compare to the amount they're spending on hardware. So he's basically saying, look, the headlines about us hiring people doesn't really matter when you think of how much we're actually spending on the hardware front. Although you could argue that you need those people to make sure that hardware actually amounts to something. But yeah, I mean, this is going to continue to be a huge spend for them. Let's not forget about Reality Labs as well, that they're putting a lot of money in. And as far as the wartime CEO comments go, I mean, look, yeah, he did great as far as getting video, leaning into things like Reels to kind of compete with Snapchat and TikTok as far as those go. But he's also had a couple of miscues. Obviously, the Facebook phone being one of them. I just don't know if everyone remembers that. And then the entire metaverse kind of debacle that we've seen. Look, he's talked about having the smart glasses and how eventually we'll have holograms, things along those lines maybe. When it comes to kind of this idea of the metaverse, but he staked the company's name on it, and now it seems as though that's kind of in the rear view, and it's all about AI now. So there's obviously he's clearly done very well to make Meta the company it is, but there have been some clear missteps as well.
Mark, if there's a letdown to be had in terms of big earnings at a large cap tech, is it how much they are continuing to spend and what that means to their bottom line?
It's definitely going to hurt their bottom line, but they're going long, they're betting big because the opportunity is that big. And when you see them buying talent, hashtag companies, they're really buying the companies and taking the talent. It tells you something, which is they have the data and they now want to manipulate that data as opposed to the companies that they're buying who has the ability to manipulate data and doesn't have the data. Small change, but a very important one. And so what you're seeing now is these big companies buying talent. That's not particularly good for venture capitalists. They are getting paid out for some of those shares, but those companies aren't going to go public. So they are going to continue this race. I would call it more of an arms race than a war, because it really is about getting that best talent in the door. We've seen it with Google, we've seen it with Salesforce, we've seen it with Amazon, we've seen it with Microsoft, we're seeing it here. And of course, we have the standalones like OpenAI. They have to do this to stay competitive in what will be the biggest race of the next decade. And this is going to be playing out for so long, but that's what they have to do, and that's what Mark thinks.
All right, well, I'll have to leave it there. A big thank you to Brooke DePalma, Mark Lehman, Dan Halley, and Stephen Biggar for joining me this morning on Opening Bid. All right, coming up, Yahoo Finance's Market Catalyst.